This is the 2018 Marginal Costing Ordinary Level question. There are 7 formulas that you need to know for your exam, and they're outlined there, so you can pause the video and have a look through them. The 6th one is not asked in 2018, so I'll do a separate video for that. In part A of the question, we're required to calculate the selling price per unit. And this is a formula, so remember, always write down a formula. It's sales over sales units. So our sales, first of all, are 880,000, and our sales units, 44,000. So we divide the two and it gives us €20 per unit. Again, it's very important you have a euro sign in and you have per unit as well. Okay, part B, we're required to calculate the variable cost per unit. The formula there is variable cost over sales units. So the variable cost in the question, 440,000. Our sales in units, as we had a second ago, sales in units, 44,000. Again, we do the division there, and again, it's €10. Let's have the euro symbol and per unit as well. Okay, part C is contribution per unit, and the formula is selling price minus variable costs. So the selling price, we're after calculating that a second ago. So the selling price, €20, and we minus the variable costs. Again, variable costs, €10. So take the two away, and your answer is €10 per unit. And again, have the euro sign and per unit as well. Okay, so we move on to part D. So part D asks us to calculate the break-even point in units and sales value. So there's two parts of that question. So in units and in sales value. Okay, so first of all in units, so the break-even point in units, the formula is total fixed costs over contribution per unit. So the fixed costs are 141,500, and the contribution per unit, calculated that a second ago, contribution per unit, €10. So divide the two in and your answer is in units. Okay, it's very important to label it units. Okay, so the second part, remember, was sales volume. So break-even point, sales value. So not volume, my apologies, value. So your answer is going to be in euro. So the formula is break-even point units by the selling price. So break-even point units, we'll just have to calculate that a second ago, 14,150, and the selling price is €20. Again, we calculated that in part A. Selling price, €20. Multiply the two, and it's €283,000. Okay, our next part is our margin of safety. The formula is units. So budgeted sales minus break-even units. So budgeted sales tells us here in part E, budgeted sales are 30,000 units. So 30,000 units minus the break-even units. So the break-even units we calculated above. So just a reminder, break-even units 14,150. So we take the two away and it gives us 15,850 units. Then we have to calculate, as it says in the question here. So remember, we've calculated the margin of safety in units. Now we have to calculate the margin of safety in sales value. So we're on the sales value bit. So margin of safety, value in euro. So it's margin of safety multiplied by the selling price. So the margin of safety, 15,850, we calculated it here. And the selling price we know from before is €20. So multiply by the two, €317,000. Okay, part F. It says prepare a marginal costing statement which includes the following. Reduce the selling price by €1. Okay, so that's the first thing I'm going to calculate. So we know the selling price is €20. And if I reduce it by €1, it'll end up being €19. Okay, so that's the first calculation that I've done. Increase the sales volume by 5%. Now we know the sales volume was 44,000 units. So we're going to increase that by 5%. So how do we do that? We do 44,000 multiplied by 0.05. That gives us 2,200. And it tells us to increase. So what do we do? 44,000 plus the 2,200. And that will give us 46,200. Okay, so 46,200. So 46,200. Okay, now we can do our sales then. So we will do our sales volume, which is 46,200 multiplied by €19, gives us 877,800 euro. Okay, next we can do our variable costs. Remember, the variable cost is based on the sales volume 46,200. And then remember, variable cost per unit is €10. Again, just a reminder where that came from part B. So variable cost per unit, €10. So just multiply by the 2, gives us 462. Obviously, we're taking our variable costs away, take the two figures away, and that gives us the contribution, which is 415,800. Now, our fixed costs were told in question. We just bring it down. Remember, costs, so we take away. And that leaves the company with a profit at €274,300. Okay, so that's either going to be a profit or loss. In this instance, it's a profit. Okay, in part G, explain the term fixed costs in relation to Shefflin Ltd. and give one example of a fixed cost that Shefflin might incur. Okay, so there's the answer for you there. Okay, so that was the 2018 ordinary level marginal cost in question.